Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us in the MarketSite studio, we have Michael Normyle, U.S. economist at Nasdaq, to discuss the debt ceiling and how government gridlock over the debt ceiling could impact the stock and bond markets, companies, investors. Michael, it's great to see you as always. Welcome back to Trade Talks. Let's just start with the basics here. What is the debt limit a tool for?
Well, it's not necessarily designed for this, but like you talked about with the government gridlock, it's become kind of a tool to get the U.S. on a more sustainable debt path. So we can see, we have a chart of debt to GDP ratio for the U.S. Right now it's about 100%, and the last time it's been that high was right after World War II. Back then, though, the economy was growing very quickly, so it got back down to the low 20s by the mid 70s, but since then it's just been climbing and climbing, and so now the Congressional Budget Office predicts that it could double by 2050 or so. So we're looking at getting on a path where we're going to have 200% debt to GDP ratio, and that's not that dissimilar from the path that Japan has been on. So in Japan, they're at 260% debt to GDP, and so the trouble that you get into is how do you keep that level of debt sustainable? And so for Japan, they have the Bank of Japan buying a lot of government bonds, keeping yields low and keeping the debt sustainable that way. But the Congressional Budget Office is saying for the U.S. that if we get to this 200% debt to GDP, we're looking at net interest costs being 7% of GDP, and federal revenues that are used to pay interest is going to be 40%. So that's compared to about 10% now. So it's just a huge chunk of money that's going to go just to paying interest.
Will the government hit the debt ceiling, and has it always increased at this pace?
Well, so we've technically hit the debt ceiling in January, but that's where the Treasury stepped in, and they have these extraordinary measures where they stop investing in federal employee retirement programs and stuff like that to kind of keep it going a little bit longer. But then, eventually we run into kind of the X date where that's no longer possible, and then that's where we potentially breach the debt ceiling. And so that it's unclear exactly when that's going to happen. It depends on some spending, some tax receipts, and stuff like that. But the expectation is between June and September or so. So that's the point where we would potentially be breaching the debt ceiling. And of course, to get back to the other part of the question, that it's been increasing very, very quickly in recent years, and a lot of that has to do with really heavy deficit spending in response to the pandemic. And then, of course, if you go back even further, there were similarly large, not quite as large programs around the financial crisis, where you also saw a big increase in debt at the same time.
How do you think the markets are perceiving the debt limit for 2023?
Well, so right now, if you look at credit default swaps for U.S. debt, it's actually, the spreads are at a record high, so suggesting that the markets are most concerned about default this time around. So if you look at a chart of the credit default swap spreads, you see spikes around the 2011, 2013, and 2021 debt ceiling showdowns. Of course, 2021, it was more muted. That's when the Democrats had the presidency in both houses of Congress, which makes it a little easier to get a debt limit put through when you have control of the entire government like that. But this time around, of course, in 2023, we know that we have divided government again. So that's contributing to why there's this greater risk that we could default.
Will we default, and what does the default mean?
Well, I think the hope is, the expectation is that we won't default. We haven't before, and the cost of doing so is so great that it wouldn't be reasonable to do so. It's Moody's estimated that we could see something like 7 million jobs lost if we breach the debt ceiling. The economy would be almost immediately in recession. You're going to have another financial crisis at the same time. So it just doesn't make sense to do that, to basically force your own economy into a recession and a financial crisis. So I think that cooler heads will prevail at some point, and we'll be able to find some kind of compromise to lift the debt ceiling, maybe rein in spending a little bit at the same time.
What should we expect from the bond market?
So for the bond market, it's mostly in the short-term Treasury yields that you see a reaction to the debt ceiling. And so in the run-up to the X date, where again, that's when the government would breach the debt ceiling, you tend to see a spike in yields just beforehand. The spike was greatest in 2013. That's also when we had a government shutdown at the same time. So the government had to fund itself and lift the debt ceiling all kind of in the 11th hour back then. So that's why that saw a bigger jump in those yields. But even in 2011 and 2021, you saw increases in the Treasury yields. And if you look at something like the MOVE index, a measure of volatility in the bond market, that is not as uniform each time, but the MOVE index is mostly related to longer term yields, so those tend to be less reactive to the debt ceiling anyway, and that's, no one's expecting that the debt ceiling is going to be broken for a long time.
What about the equity market?
So for the equity market, you do see a run up in volatility, like with the VIX measure there. It's in 2011, 2013, and 2021, it also increased, but you do see a huge spike in the VIX after the X date in 2011, but that was more because the political brinksmanship, as S&P called it at the time, resulted in S&P downgrading the US credit rating from AAA to AA+, which is where it remains. So you do get increased volatility in equities, and you also see some sell-offs in equities too. The sell-off was biggest again in 2011 because of that credit downgrade.
So when we put all this together, what does this mean?
So you can expect more volatility in equities, potentially a sell-off in equities, and we've seen research shows that when there is this increased volatility, it can be worse for companies about to IPO, which could negatively impact capital formation. And then, of course, with the Treasury market, there's likely to be some increase in the short-term yields.
All right, let's hope cooler heads prevail. Michael, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.